Building a trading plan is often misunderstood as a technical exercise, a checklist of rules written once and then followed mechanically. In reality, a trading plan is a psychological contract you make with yourself before money, emotion, and uncertainty enter the room. Trading literature written by consistently profitable traders is clear on this point. The plan is not there to help you win more when things go well. It is there to protect you when things do not. A good trading plan does not eliminate mistakes, but it makes them visible, containable, and survivable. And that is why it becomes the backbone of long-term consistency. The first step in building a trading plan is defining your purpose, not in abstract motivational terms, but in practical ones. Why are you trading, and what role is trading meant to play in your life right now? Is this a learning phase, a supplementary income phase, or a full-time professional pursuit? Many traders skip this step and unknowingly create plans that conflict with their reality. A plan designed for income generation will fail if you are still emotionally learning. A plan designed for learning will feel frustrating if you expect consistent profits. Trading literature repeatedly shows that misalignment at this foundational level creates pressure that no rule set can fix. The second step is choosing your market and time frame deliberately. A trading plan must narrow focus before it adds detail. Which markets will you trade, and which will you ignore? On what time frame do you make decisions, and on what time frame do you manage risk? This choice should be driven less by what looks exciting and more by what you can execute calmly. Fast time frames demand constant attention and rapid decision-making. Slower time frames demand patience and tolerance for overnight risk. Neither is superior. The right choice is the one that allows you to follow rules without fighting your own temperament every day. The third step is defining your edge in simple, observable terms. This is where many plans become vague. A real trading plan states clearly what must be present for a trade to exist. Market context, structure, confirmation, and invalidation should all be described in language you can apply consistently. If a setup cannot be explained without interpretation, it cannot be executed under pressure. Trading literature consistently emphasizes that clarity beats cleverness. A plan should reduce decisions, not create them. The fourth step is risk management, and this is not a section of the plan, it is the core of it. How much will you risk per trade? What is your maximum loss per day or per week? How many trades are you allowed to take? Where is a trade considered invalid? These rules must be explicit and non-negotiable. A trading plan that leaves risk flexible invites emotion to fill the gap. When risk is predefined, losses stop feeling like emergencies and start feeling like expected costs. This emotional shift is one of the most valuable outcomes of a well-built plan. The fifth step is execution rules. This includes how you enter trades, how you manage them, and how you exit them. Do you enter at market or with limit orders? Do you scale in or enter once? Do you take partial profits or exit fully? These decisions should be made in advance, not improvised in the heat of the moment. Trading literature repeatedly warns that most mistakes occur not because traders lack knowledge, but because they improvise under pressure. A plan exists to remove the need for improvisation. The sixth step is defining rules for doing nothing. This is one of the most overlooked yet most important parts of a trading plan. Under what conditions are you not allowed to trade? Low volatility, extreme volatility, emotional imbalance rule, violations earlier in the session. A plan without no trade rules slowly bleeds capital through marginal participation. Inactivity is not a failure, it is a strategic position. A complete plan treats waiting as an intentional act, not an absence of action. The seventh step is review and accountability. A trading plan that is not reviewed becomes a document, not a process. How will you journal trades? What metrics will you track? How often will you review performance? And what will you focus on during review? Trading literature emphasizes that improvement comes from feedback loops. The plan defines behavior journaling records, behavior, and review adjusts behavior. Without this loop, the plan stagnates and discipline erodes quietly. The final step in building a trading plan is accepting that it is a living framework, not a finished product. Early versions will be imperfect. Rules will be tested. Assumptions will be challenged. This is not failure, it is refinement. A good trading plan evolves slowly based on evidence rather than emotion. Changes are made deliberately, not reactively. Over time, the plan becomes simpler, clearer, and more aligned with who you are as a trader. When all these steps come together, the trading plan stops feeling like a restriction and starts feeling like support. It carries decisions when emotion is loud. It creates consistency when outcomes are mixed. It protects capital and clarity simultaneously. And it is precisely at this point, when the plan begins to absorb uncertainty so that you do not have to, that trading shifts from a reactive activity into a structured practice one, where progress is measured not by occasional brilliance, but by the quiet ability to follow your own rules again and again, even when the market tempts you to abandon them. And this is where the deeper work continues, as the sentence itself has not yet fully come to rest. Because once the plan begins to carry uncertainty for you, discipline stops being something you constantly have to summon and starts becoming something you return to. This is the stage where a trading plan moves from theory into lived experience. You begin to notice that difficult days feel less chaotic, not because the market is kinder, but because fewer decisions are being made in the heat of the moment. The plan absorbs noise. It narrows choice. It gives you something stable to stand on when price movement tries to pull you into reaction. At this point, one of the most important shifts is learning to trust the plan more than your feelings. Feelings will fluctuate daily. Confidence will rise and fall. The plan is designed to remain steady through those fluctuations. Trading literature often notes that traders do not fail because their plans are flawed, but because they abandon them during emotional peaks and valleys. Living with a plan means allowing it to override impulses, especially when those impulses feel justified. This is uncomfortable at first, yet it is exactly where consistency is trained. As the plan is executed over time, patterns begin to reveal themselves. You see which rules protect you the most and which ones are most tempting to break. These temptations are not signs that the plan is wrong. They are signals about your psychological pressure points. A mature trader does not remove rules because they are uncomfortable. They investigate why they are uncomfortable. Often, the rules that feel most restrictive are the ones preventing the most damage. Refinement now becomes subtle. Instead of rewriting the plan after a bad week, adjustments are made slowly and with evidence. A rule is questioned only after repeated observation, not after frustration. Trading literature emphasizes this patience because reactive changes are often disguised attempts to escape discomfort. A strong plan evolves through calm review, not emotional relief. Over time, unnecessary complexity falls away, leaving a leaner, clearer framework that is easier to execute under stress. Another critical development at this stage is the strengthening of no-trade discipline. The plan's rules for standing aside begin to feel as important as its rules for entry. You start to recognize days when your edge is simply not present, or when your internal state is misaligned. Respecting these signals becomes a mark of professionalism rather than hesitation. Many traders credit their long-term survival not to great trades, but to great decisions not to trade. As the plan matures, confidence shifts again. It is no longer confidence in the next trade, but confidence in recovery. You know that losses will occur, and that the plan is built to absorb them. This knowledge changes how you experience drawdowns. They are no longer personal failures, but expected phases within a defined structure. This emotional stability is one of the most underrated benefits of a well-built trading plan. Eventually, the plan becomes internalized. You no longer need to read it word for word each day, because its principles guide behavior automatically. Yet even at this stage, disciplined traders revisit the written plan regularly, not because they forget it, but because repetition reinforces respect. The plan is treated as a living agreement, one that must be renewed daily through adherence, rather than assumed permanent. In the end, building a trading plan is not about controlling the market. It is about controlling how you participate in it. A good plan does not promise profits. It promises structure protection and a clear feedback loop. It gives you a way to show up consistently in an environment that offers none. And when that structure is honored, day after day, trading transforms from an emotional struggle into a disciplined practice, where progress is slow, quiet, and deeply earned, and where the greatest achievement is not a perfect trade, but the ability to follow your own rules, even when doing so feels difficult, because that ability is what allows everything else to compound over time. If this step-by-step reflection on building a trading plan helped clarify what your own plan is missing or overcomplicating, consider subscribing to continue exploring the foundations of sustainable trading, and leave a comment sharing which part of your plan you now see as most critical to strengthen.